Ever wish you could just see price action patterns on your charts, feeling lost in the chaos of market structure? I've got a game changer. This indicator visually highlights key price action areas directly on your charts, simplifying your analysis like never before. It's not based on lagging indicators, but pure price action, working on any market and any time frame. Want to see how it pinpoints fair value gaps, order blocks, and even liquidity graphs? This is Price Action Toolkit by Flux Charts. I'll cover the indicator features and what they do. If you want to access this indicator, follow the link in the description or pinned comment. So, in the TradingView indicator section, search for Price Action Toolkit by Flux Charts and add it to your chart. One of its coolest features is how it handles fair value gaps, or FVGs. Now, FVGs are basically temporarily price gaps that happens when there's a big imbalance between buyers and sellers. It creates this area on the chart where price can move pretty freely. Now, usually finding these fair value gaps means looking for a 3-candle pattern, a big candle between 2 smaller ones. However, you don't need to search for them anymore because this toolkit does all the hard work for you. It finds these fair value gaps automatically and even draw a highlighted area on your chart. But it gets better. You can go into the toolkit settings and find helpful adjustments for the fair value gap detection. For example, you can turn on volumetric info, which shows the amount traded within that gap. You can also change the zone invalidation and zone filtering settings. Additionally, there's a volume threshold for FVG detection, which lets you set a minimum volume level for finding FVGs. Finally, the detection sensitivity settings allows you to fine-tune how aggressively the tool finds FVGs. These settings help you take control and make your analysis more accurate. It's quite impressive, isn't it? As you can see from the examples, the indicator is very effective in finding fair value gaps on almost any chart you use. Next, let's discuss something called order blocks. Imagine the market as a big auction where buyers and sellers are continuously competing. Sometimes there are hidden areas of intense activity when many orders are waiting to be filled. These areas are called order blocks. To understand this, think of a dam holding back a river. The water represents all the pending orders. When the dam breaks or when price reaches the order block zone, you get a significant reaction in the market, like a burst of energy being released. On your chart, order blocks appears as colored zones. The interesting thing is that these zones act like magnets for prices. When the price returns to one of these areas, it often bounces because all the waiting orders are triggered. So the key is to take advantage of that movement, not go against it. If the price drops back into a green bullish order block, it may be a good time to look for buying opportunities. On the other hand, if the price rises back into a red bearish order block, consider selling. Now we'll discuss breaker blocks. We've already talked about order blocks, zones where many orders are waiting to be filled, causing significant market reactions. A breaker block is an order that didn't function as intended. It's like a failed attempt to maintain the price. Imagine this. The price approaches a bullish order block, an area filled with buy orders. It bounces a bit but then breaks through. That order block is now invalidated and transferred into a breaker block. It's like a broken dam. The water, or the price in this case, has breached it. Here's the interesting part. These failed order blocks or breaker blocks often becomes areas of substantial support or resistance. Remember how broken resistance can become support? It's a similar concept. Since there was significant activity around the original order block, the area remains important. It's a zone where the market reacts strongly, even if it ultimately failed. How can we use this? If the price revisits a bearish breaker block, one that was initially a bearish order block but was broken to the upside, that area may now act as a support, signaling potential long trades. On the other hand, if the price returns to a bullish breaker block, one that was originally a bullish order block but got broken to the downside, that area may now act as a resistance, suggesting possible short trades. Alright, now let's discuss the break of a structure, or BOS. Think of it as the market providing confirmation that it will continue its current movement. It's like the market signaling, yes, I'm still heading in this direction. A bullish break of a structure occurs when the price surpasses a previous high. It's as if the price is climbing a staircase and has reached a new higher step, indicating the uptrend will likely persist. Conversely, a bearish break of a structure happens when the price drops below a previous low. It's akin to the price descending a staircase and creating a new lower step, suggesting a continued downtrend. An important point to remember is that the BOS isn't necessarily a signal to enter a trade immediately. It serves more as a confirmation of the market's direction. It's not about identifying the ideal entry or exit point, but rather about affirming the market's overall trend. Imagine you have a long position, anticipating that the price will increase. If you observe a bullish break of a structure, consider it a signal to maintain your position. The market is validating your analysis. The same logic applies if you have a short position and witness a bearish break of a structure. It indicates that you should stay in the trade because the market confirms the downtrend. Alright, we just discussed the break of a structure, which indicates a trend's continuation. Now let's explore what happens when a break of a structure doesn't occur, resulting in a change of character, or CHOCH. Consider this as the market altering its course, suggesting a possible trend reversal. Picture the scenario. The price follows a clear uptrend, producing higher high and higher lows. We anticipate a bullish break of a structure, a breakout above the previous high, affirming the uptrend's persistence. However, instead of surpassing the high, the price unexpectedly declines, breaching a previous low. This unsuccessful BOS, the inability to maintain the pattern, is our change of character. Is as if the market is losing momentum and exhibiting signs of vulnerability. A bullish change of character informs us that a downtrend may be concluding and an uptrend could commence. The market structure transitions from bearish to bullish. Conversely, a bearish change of character indicates the opposite. An uptrend might cease and a downtrend might emerge. The market structure shifts from bullish to bearish. Now let's discuss equal highs and equal lows, abbreviated as EQHs and EQLs. These patterns are easy to identify on a chart and can offer insights into possible price movements. Picture the price moving upward and reaching a peak known as a swing high. Subsequently, it retreats slightly before returning to the same peak level, but it cannot break through. It gets rejected at that point. These two peaks, occurring at approximately the same height, are referred to equal highs. On the other hand, equal lows represents the opposite scenario. Envision the price moving downward and hitting a bottom, a swing low. Then it rebounds slightly before returning to the same bottom level, but it cannot break through. It gets rejected at that point. These two bottoms occurs at roughly the same level, constitute equal lows. Equal highs and equal lows are areas where the price has attempted to break through a previous high or low but failed. These regions can serve as potential support and resistance levels. If the price approaches equal highs, it may face challenges breaking through, which could suggest a potential reversal or pullback. So that wraps things up. The link of the Flux Chart Price Action Toolkit we've been using is in the description and pinned comment. So go check it out.